I have watched enough markets to know that most people do not lose their money when the news gets bad. They lose it when the market stops feeling human. That is the moment we are approaching now. Not because earnings suddenly disappeared, not because every business in America forgot how to make money, not because value itself vanished in a week. What is breaking right now is something more dangerous. The tape is losing discretion. It is turning into a staircase built by rules, thresholds, volatility triggers, dealer hedges, currency flows, and machines that do not care whether you are confident, scared, early, late, smart, or exhausted. Most investors still imagine a sell-off as a room full of people changing their minds. That is not the room I see. I see a chain of automatic doors. One door closes, another one locks, and the people inside start running toward the next exit. Then that exit narrows too. Then the floor gets thinner. Then someone who never wanted to sell becomes the next forced seller. That is why a normal decline can become an air pocket. That is why a mild pullback can begin behaving like a mechanical event. And that is why the investors who survive this phase are usually not the ones with the strongest opinions. They are the ones who understand the staircase before their feet touch it. When I was younger, I thought intelligence in markets meant predicting the next headline. Age cured me of that idea. The market does not pay you for sounding informed. It pays you for understanding pressure. Pressure is what matters now. You are looking at a market where trend-following machines have already sold aggressively, where dealer positioning can amplify weakness instead of cushioning it, where volatility is close to levels that trigger another class of forced reductions, where liquidity is thin enough that large orders hit harder than usual, and where the dollar itself is acting like a vacuum cleaner for global stress. Buffett-style file 0 Fe, that combination is not random, it is a system. And if you do not understand the system, you will confuse the symptom for the cause. You will think the market is falling because investors suddenly became pessimistic. Sometimes that is true right now. That is too shallow. The market is falling because certain participants are built to sell after weakness, not before it. They are built to react after a line breaks, after a volatility bucket fills, after a hedging program flips, after a signal goes from neutral to defensive to outright short. That difference matters enormously. A man selling because he is worried can change his mind. A machine selling because a threshold broke does not have a mind to change. I want you to picture a hill covered with snow. When the first layer slips, that is not yet the avalanche. That is the permission structure for the avalanche. One drift moves, weight shifts, another shelf loosens, then an entire face of the mountain gives way. Not because every snowflake wanted to move, but because enough of the structure beneath them changed. That is what I mean by an automatic liquidation staircase. The first step is trend pressure. There are large systematic funds that live by trend rules. If prices are strong, they buy. If prices weaken enough, they reduce. If prices break deeper levels, they sell harder. If the damage extends, some of them do not merely go flat, they turn short. That is not moral failure. That is their design. In the source material you gave me, those funds had already sold tens of billions in U.S. equities this month and were positioned to sell more in a flat tape, more in a down tape, and even more over the next month if prices kept sinking. Buffett-style file 0 Fe. The ordinary investor hears a number like that and thinks in headlines. I hear plumbing. Who is the buyer on the other side? How thick is the market? How much depth is really there when selling comes in waves? How many people are standing close enough to the door that they can get out before the doorway shrinks? That brings me to the second step, which is liquidity. People throw that word around as if it were a technical ornament. It is not. Liquidity is the width of the bridge. When liquidity is healthy, fear travels slowly because the market can absorb disagreement. One man sells, another buys. Prices move, but the floor remains. When liquidity is thin, the bridge narrows. A moderate order starts behaving like a large one. A large order starts behaving like a forced confession. What should have been a walk turns into a stumble. The source material described SP top of book liquidity at weak levels on a one-year basis, which means the ability to transfer risk quickly was already compromised before the next wave of selling arrived. Buffett-style file 0 Fe, that is exactly the kind of condition in which a market stops acting graceful. Thin liquidity is what turns routine selling into an event. The third step is dealer pressure. This is where the average investor loses the plot. He thinks option markets are a sideshow. They are not a sideshow in moments like this. They are the amplification chamber. When a large amount of options positioning leaves dealers short gamma, they often have to sell into weakness and buy into strength. In plain English, the market drops and the people hedging the structure are pushed to reinforce that drop. The market rises and the same structure can reinforce the rise. Again, this is not ideology. It is mechanics. The source material described dealers sitting in a very short gamma pocket, one of the lowest readings on record, which matters because the market is no longer getting stabilizing behavior from that part of the structure. Fay file A site, Fay turn 12 file 0 Fay so. Now your staircase is getting steeper. Trend followers have begun selling. Liquidity is weak. Dealer hedges are not cushioning the move. They are helping the move breathe. Now we come to the fourth step, which is the most misunderstood of all, volatility control. This is where quiet money becomes dangerous money. Many investors assume the violent actors are hedge funds, day traders, or some fellow on television who cannot sit still. But one of the largest pools of mechanical behavior often sits inside products sold as safe, managed, disciplined, protective, retirement-friendly. That is the joke the market plays on people. The safety narrative is often attached to the most automatic behavior in the room. Volatility, control strategies, risk targeting products, annuity structures, and related systems are often designed to reduce risk when volatility rises and re-add risk when volatility falls. Sounds sensible, sounds adult, sounds prudent. And it is prudent right up until everybody owns the same kind of prudence. Then prudence becomes synchronized selling. Then the strategy that promised calm turns into a fire code. If the VIX stays contained, those vehicles may sit still. If volatility pushes through their trigger range and stays there, they begin cutting exposure. And because they are very large, they do not add a little pressure. They add a class of pressure. The source material made plain that this pool had not yet fully triggered, which is exactly why it matters. You do not fear only what is sold, you fear what is built to sell next. Faithful site, Fay turn 12 file 0 Fay. A great many fortunes are damaged because people study visible selling and ignore latent selling. Visible selling tells you what has happened. Latent selling tells you what the structure is waiting to do. That is the difference between reading the tape and reading the staircase. Now add the fifth step, the dollar. This part seems abstract until it is not. When the dollar strengthens during stress, it does not merely create a chart pattern. It tightens the room, it pulls capital, raises the burden on risk assets, pressures global positioning, and tends to move in sympathy with higher volatility at exactly the wrong time. The source material paired dollar strength against euro weakness with the risk of further market stress, and also showed a short-term relationship between dollar breakout behavior and rising volatility. Faithful site, Fay turn 12 file 0 Fay. This is crucial because many investors think the bottom arrives when stocks feel cheap. That is not how stress bottoms tend to form. A real bottom often requires a release valve. Something has to stop tightening, the dollar stops climbing, volatility spikes and begins to retreat. Machine sellers reach exhaustion, dealer pressure relaxes, volume finally appears with buyers willing to absorb inventory. You stop getting lower prices on weak participation and start getting strong participation at lower prices. Until then, cheap can become cheaper in a very impersonal way. That is why I have no respect for the phrase buy the dip when it is spoken like a reflex. A dip is not an opportunity by definition. A dip is simply a lower price. Whether it is an opportunity depends on what kind of lower price you are looking at. Is it a lower price caused by a temporary emotional overshoot while the structure is healing? Or is it a lower price inside an active liquidation staircase, where the next class of forced seller is still standing above you? Those are completely different worlds. One invites patience, the other punishes eagerness dressed up as courage. I learned a long time ago that most people do not really want bargains. They want reassurance wearing the clothes of a bargain. They want to buy after enough bad news to feel brave, but before enough structural damage to feel endangered. The market rarely offers that combination. If you want the reward that comes from acting well in stressful conditions, you must first accept the discomfort of not being able to name the exact bottom. You must trade certainty for process. And that leads me to the central identity shift in this whole story. Most investors think of themselves as opinion owners. They consume narratives, they form views, they declare bullishness or bearishness. They argue about whether the market is irrational. That identity is useless to me in a liquidation staircase. I want a different identity. I want to be a reader of pressure. A reader of pressure does not begin with what he wishes the market would do. He begins with who is being forced, who must sell if this line breaks, who stops supporting the tape if this bucket empties, who needs volatility lower, who gets hurt if the dollar goes higher. who has already sold enough that reflexive reversal risk is building, who has not sold yet but is close to needing to. That is a better identity because it replaces ego with sequence, and sequence is everything. Now let me make this more concrete. When I look at a market like this, I do not ask a single big question. I ask a chain of small ones. I ask whether the trend machines are already near max short or still have room to press. I ask whether the volatility-control crowd has triggered or is merely flirting with activation. I ask whether dealer positioning is likely to reinforce the next leg down or fade it. I ask whether hedge funds are still distributing size or whether capitulation is becoming crowded. I ask whether retail has shown up as a stabilizing dip buyer or stepped back from the floor. I ask whether the dollar is still rising hard enough to keep financial conditions tight. And I ask the one question almost nobody wants to ask because it sounds too simple. Where are the actual buyers? Not the theoretical buyers. Not the people on social media promising to buy if it falls another 10%. Not the strategists explaining why long-term returns will eventually be fine. Not the man telling me that the market always comes back. Where are the buyers today? Have they shown themselves in volume? Have they produced a day where the market flushes, prints fear, and still closes with conviction? Has weak liquidity met real sponsorship? Has panic encountered appetite? The source material was very clear that one sign missing so far was the kind of volume spike and constructive reversal behavior that often marks a tradable low, Fay file site, Fay turn, 12 file 0 Fay that matters. People love using history as comfort. I use it as discipline. History says markets recover fine, but history also says recoveries often begin after conditions become unbearable for the unprepared. History says some of the best rebounds come after the ugliest headlines. Fine again, but history also says many investors are absent for those rebounds because they were emotionally broken or structurally forced out before the turn arrived. I am not interested in merely being right over 10 years in some philosophical sense. I am interested in being present for the good years by surviving the bad mechanics. That is a different standard. And survival in this phase has less to do with genius than with protocol. So let me tell you the protocol I would want a serious investor to adopt here. First, remove the parts of your portfolio that turn volatility into compulsion. That means leverage that can force your hand. That means oversized positions that make you watch every tick like a hostage. That means exposures so concentrated that one weak pocket in the market can define your emotional state. If a position is large enough that a further mechanical unwind would make you irrational, the position is too large. I never confuse conviction with fragility. If your conviction depends on the market not testing you, it is not conviction. It is borrowed confidence. Second, separate valuation from timing. A good company can become a bad trade for a while if the tape around it is being governed by systematic selling. I have owned wonderful businesses at bad entry points and felt that lesson in my bones. Quality matters enormously, but quality does not cancel mechanics in the short run. If a broad risk-off cascade is underway, the first task is not to prove your courage. The first task is to avoid paying emotional prices for assets that may be offered to you lower by somebody who has to sell tomorrow. Third, stop trying to predict headlines and start mapping triggers. You cannot know the next geopolitical rumor. You cannot know the exact payroll number. You cannot know what some central banker will mumble in public and reverse in private. But you can know this. You can know what your own account looks like if volatility rises further. You can know what you will do if the market loses another 5%. You can know what you will do if volume surges and buyers finally appear. You can know what you will buy first, what you will ignore completely, and how much dry powder you are willing to commit at each stage. That is how adults behave in markets. They do not substitute drama for preparation. Fourth, understand that a crowding of pessimism is not yet the same thing as a completed washout. The source material noted very bearish hedge fund flows, significant machine selling, and absent or weak retail support, Fay Felicite Fay turn 12 file 0 Fay. That can mean two things. It can mean we are getting closer to an inflection point, or it can mean the next layer of automatic sellers will have cleaner air to operate in because fewer discretionary buyers are standing underneath. The difference is usually made by volatility and liquidity. If volatility cools, the staircase can flatten. If volatility rises, the staircase extends. So do not say everybody is bearish, therefore buy. Say everybody is bearish, therefore ask what remains unfired. Fifth, keep a watch list built for re-entry, not fantasy during emotional sell-offs. Most people build two lists. One is a wish list filled with stocks they already loved at higher prices. The other is a revenge list filled with names they feel they deserve to buy because they missed them on the way up. Neither list is useful. Your real list should contain assets you would be proud to own if the market were closed for years. Priced at levels that compensate you for uncertainty, funded with capital you are not likely to need soon, and sized in a way that lets you keep thinking if the market drops after you buy. If you cannot satisfy those conditions, you are not buying. You are lunging. Now, I want to talk about reversals, because no discussion like this is complete without that temptation. Mechanical selling creates some of the sharpest rebounds you will ever see. That is because once a portion of the staircase empties, the flow can reverse fast. Short sellers cover, machines stop pressing, volatility declines, dealers hedge the other way, suddenly the market feels alive again. That is how people get trapped twice. They panic in the decline, then they chase the rebound as if the correction never happened. I have no interest in either error. If a reversal begins, I want to know whether it is merely reflexive or whether it is structural. Did we get one good day because positioning was stretched? Or did the conditions that made the staircase dangerous begin to change? Did the dollar pause? Did volatility lose altitude? Did liquidity improve? Did buyers finally show up in size? Did the tape stop behaving like a forced market and start behaving like a clearing market? The difference is subtle until it is expensive. The source material made the point that very deep short positioning can create reversal risk. That is true, very often true. But reversal risk is not the same as a durable floor. Fay file site Fay turn 12 file 0 Fay durable floor usually requires not just exhaustion from sellers but affirmative behavior from buyers. That is what I wait for. People say waiting is passive. That is nonsense. Waiting with criteria is an active form of discipline. I do not wait because I am afraid to act. I wait because I prefer evidence to adrenaline. Now let me tell you where the real wealth opportunity sits in all of this. Because there is one, it is not in proving you are unshakable. It is not in calling the exact bottom on social media. It is not in shorting every downtick as if panic were a profession, and it is certainly not in acting like a machine while still trapped inside a human nervous system. The real opportunity is to build an operating system that lets you stay solvent, clear, and opportunistic while other people are being recruited into forced behavior. That is what the best investors quietly do. They lower the odds of compulsion, they do not worship activity, they preserve optionality. If this staircase deepens, they still have cash, they still have attention, they still have a watch list, they still have emotional room. They are not trying to rescue bad positioning with new positioning. They are not selling good assets merely to defend fragile structures. They can wait until the market offers them terms they actually want. Optionality is a richer word than bravery. Bravery sounds heroic, optionality pays better. And optionality is built long before the panic. It is built by modest leverage, sober sizing, diversified sources of strength, and the willingness to look boring during easy times so you can look intelligent during hard ones. I have met many men who wanted to feel rich. Far fewer wanted to remain liquid, patient, and hard to force. The second group wins more often than the first. I think about investing the same way I think about business. The best business is not the one with the most exciting quarter. It is the one that can survive stress without begging for mercy. The same is true of a portfolio. A portfolio should not be designed only to enjoy rising markets. It should be designed to avoid becoming food for automatic sellers when the environment changes. If you own assets that require perfect weather, you do not own a portfolio. You own a forecast. And forecasts are fragile. This is why I like simple rules more than dramatic speeches. Write them down. If volatility expands and the next layer of machine sellers triggers, what will you not do? What will you reduce? What will you wait for? What price zones matter to you? What evidence do you require before adding? What size of first purchase keeps you sane if the tape worsens? What will tell you the dollar pressure is easing? What will tell you the market has found a real sponsor? Without those answers, you are not prepared. You are merely informed information without protocol. Is one of the great illusions of modern finance. People think because they know more, they will behave better. Usually they just narrate their own mistakes with better vocabulary. I am not after better vocabulary. I am after durable behavior. So here is the final choice I would put in front of you. You can live like a commentator or you can live like an owner. The commentator watches thresholds break and feels compelled to produce a feeling. He must react. He must declare. He must be early. He must sound clever. He mistakes participation in the emotional atmosphere for financial progress. The owner does something else. He asks whether the staircase is still active. He cuts anything that can force him. He protects liquidity. He studies where pressure is building. He waits for evidence instead of begging for relief. And when the market finally shifts from automatic liquidation to genuine clearing, he acts with a calm that looks effortless only, because the hard work was done before the signal arrived. That is the mirror I would hand you tonight. Not whether you are bullish, not whether you are bearish, not whether you can stomach one more bad week. The real test is simpler. Are you built to survive a market ruled by pressure, or are you still built for a market that requires everyone to behave politely, because the polite market is gone for now? This one has stairs, and if you insist on pretending they are not there, the market will teach you the shape of each step with your own money. I would rather learn the staircase before I put my full weight on it. That is what I am doing, and if I were you, that is the contract I would make with my future self before next week begins.